Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Lazard's Ron Temple saying this: I still see upside for US equities, but will have to be driven by earnings growth from here. So far, the upside in the S&P has been narrow, but I expect the earnings growth to broaden out as we move through 2024 with better participation from other sectors beyond the tech and communication services and the Fab 5. Ron's with us around the table. Morning, Ron.
Good morning.
We're not talking about Mag 7, we're talking about Fab 5.
Yeah,
who did we drop?
Well, if you look at the year-to-date, basically Apple and Tesla have been a drag, even including yesterday's gains from Tesla. So really, it's the 5 stocks. And if I look at the earnings results so far this quarter, all of the earnings growth is 5 stocks again. So we're back in that story that we've had for the last 2.25 years, where the rest of the S&P 500 is really not giving us much to get excited about. But I think that's going to change as we move through the year.
What tells you it's going to change?
Well, part of it is I look at it and say the only way this demand for AI and technology investment can be sustained is if the customers get a return on investment. And companies aren't going to keep pouring money into these products and services unless they see some benefits. The key question to me is how quickly do we see those benefits? Do they show up in the 2024 P&L? I'm a little skeptical. I'm hopeful on that front. But more importantly, I think as we start looking at the prospect of rate cuts, not just rate increases, interest expense will shift income statements in the market. And I think we're basically seeing an ongoing demand that's shifted from goods towards services, and that should also broaden earnings growth.
This was a story about 6 months ago, too, and a lot of people were talking about eventually we'd start to see things broadening out with rate cuts. And then it got pushed out 3 months, then another 3 months. Basically, are we in purgatory until we get the sense that the Fed is actually going to cut rates? And if they don't, you're not going to get a broadening out from the Fab 5 for the foreseeable future.
Well, I guess this is where a key underlying assumption for me is I'm still optimistic on the inflation front. I fully recognize the first quarter was an ugly surprise, right? January, I thought, okay, we can look at this and maybe it's a January anomaly. But we got February, and February was much better. But then March was kind of crushing in terms of that optimism. We had service inflation ex-shelter go from 5.1% annualized in the fourth quarter to 8.7% in the first quarter. Core PCE went from 1.6 to 4.4. I still think as we move through the year, you're going to see the labor market showing us an easing of tightness. And I think we're going to see that pricing pressure in the service sector start to ease. One of my favorite anecdotes, by the way, auto insurance has been basically 80 basis points of the 3.8% of core CPI over the last year. It's 3.5% of the index. Now, auto insurance rates are still going to go up for the next 6 months probably, but not at 22% annualized.
Steve Rashuda, though, of Mizuho would say you can cherry pick what you want. You still will have, you can get to 2% any which way. What would you have to see in some of the numbers that are coming out, starting with ECI, going to JOLTS that we get tomorrow, going to the payrolls report on Friday, as well as ISM data? What would you have to see to change your view?
Well, I guess what I would want to see, and back to the data this week, I think the ECI is probably one of the best metrics for wage growth. It's fully comprehensive, wages and benefits. It also works better in terms of adjusting for mix shift. If you look at average hourly earnings that we're going to get on Friday, that can be skewed. If you get more low-paying jobs, it makes wage growth look lower, so that one is probably less valuable. So on ECI, I want to see basically anywhere from a 90 to 100 basis point reading. It would be great if we saw something below that. I don't know if we see a 1.2, 1.3, that's going to spook the markets. I think if we look at the JOLTS data, questionable in terms of reliability. If you look at the response rate to the JOLTS survey, it's gone from 65 to 70% pre-pandemic to 30 to 35%. So some people do question if the data is reliable. I like to watch the quits rate within the JOLTS data. That tells you, are people finding better jobs where they're getting higher wages and they're moving? So it's another anecdote. And then on Friday, we'll wait and see. The market is saying around 240,000 new non-farm payrolls. We need about 130 to 140,000 in a typical environment to keep pace with population growth. If we get a big upside surprise and more positive revisions, that's going to make me a little more nervous that maybe this economy is reaccelerating. And by the way, if I take this alongside the data out of Europe this morning, upside surprises across the Eurozone, positive, albeit marginal commentary coming out of the Politburo in China. There is a risk that there's a reacceleration here and that would basically undermine some of my optimism on inflation.
To John's point earlier, so do you think Europe and China are catching up to the U.S. exceptionalism that maybe is petering out?
That might be a little too optimistic. I guess I look at Europe and saying going from zero to something positive is really great. But, I do think there will be improvement this year. And I would also note, I think the case for the ECB cutting rates is a lot stronger. I mean, you basically don't have debating, and we're not debating whether Europe is reaccelerating. We're basically, it's clear that Europe's going from zero to something very low on growth. And inflation has been smoothly decelerating in Europe. So I think you're going to get 100 basis points of rate cuts from the ECB this year. And very importantly, monetary policy decisions in Europe have a more immediate and magnified impact on the economy than the U.S. because a lot more of the corporate rate is floating rate and a lot more of the household debt is floating rate.
So right now you're saying that your base case is you're going to get inflation coming in lower and you're going to get some rate cuts. What's the playbook if you do see that reacceleration in inflation and that case comes to play?
Yeah, if you get a reacceleration, then I think the Fed ends up keeping rates where they are. I don't think you're going to see the Fed raising rates from here. I don't buy into that hawkish thesis at all. I think 5.25 to 5.5 on Fed funds is plenty tight in real terms. And again, I appreciate the question, but when I look at the data, there's one part where there's a lot of uncertainty, and that's really the service ex shelter. If we look at the shelter inflation, we know from the Zillow Observed Rent Index that inflation there has basically declined sharply. It still hasn't shown up in the CPI, but historically there's a one-year lag between Zillow and CPI and PCE. Based on Zillow, we know inflation for rent has gone from 16% 2 years ago to less than 3.6% for the last 9 consecutive months. CPI is still printing 6. So we know that part of inflation is coming down. We know core goods prices are still going to be soft because we can watch the Manheim Used Car Price Index. So when I piece it together, for basically 69% of core CPI, I know inflation is staying lower, going lower. So I guess I have a hard time with the thesis that overall inflation is accelerating. I don't see that as likely. And I think we'd be better off focusing on what is the base case. We've gone from 9% inflation to close to 3%. There's been a lot of progress. Real interest rates are up a lot. And I think it's time for the Fed to basically start focusing on the other leg of the dual mandate, which luckily they don't have to worry about because the job market is strong. But if we can have a 3.5% unemployment rate and still get to the inflation target, that's how we should be thinking about later this year.
Two phrases I want to unpack with you. Plenty tight, plenty progress. Plenty tight. What evidence is there that we're plenty tight? And on the plenty progress, how much evidence is there that that's just a supply-side story, not a demand one driven by the Fed, which you say is plenty tight?
I'm really glad you went there because I think one of the other things that's happened is if we look at growth expectations in the U.S., the consensus for 2024, ECFC on your Bloomberg terminal,
I knew where you were going.
Is 2.4%. Just want to make sure I'm fresh. 2.4% for this year. If you go back to October, it was 50 basis points. So there's a lot of optimism around economic growth in the U.S. But there are signs of cracks. If you look in the consumer, mortgage and credit card delinquencies are up 40% year on year. Now, again, from a very low base. Auto delinquencies up 20%. In the Wall Street Journal this morning, there's another article about how many commercial real estate loans are coming due. The Mortgage Banker Association is saying $929 billion of maturities this year, $206 billion of which are office. You're going to see defaults on commercial property. We saw another bank failure in the last week. You're going to see more bank failures. There are going to be news stories that come through that start to chip away at some of this optimism. And so I think it's a little easy to get caught up in the excitement of current data and to say, what tightness? But the reality is monetary policy acts with long and variable lags. And I think we're going to see some of those lags come into play this year as the consumers depleted their excess savings, has trouble paying their debts, and as corporates actually find carrying these much higher interest expenses gets pretty difficult over time.
The short answer is wait. Ron Temple of Lazard. Ron, thank you, sir. Love a real-time conversation supported by Bloomberg and a terminal. We love that. Thanks, Ron. With us around the table is Citi's Rob Sockin. Citi's Rob Sockin joins us now, looking ahead to the Federal Reserve tomorrow and the data on Friday. Let's talk about the data that we just got. How much does that change things tomorrow?
This is a challenging print for the Fed. It's not quite a nightmare, but it's something akin maybe to a really bad dream. Coming in at 1.2 is just evidence that the inflation data, the wage growth data is moving in the wrong direction to be consistent with their target. And you already got a lot of hints of that with the Q1 inflation data. And, a saving grace may have been if wage growth showed continued signs of cooling on a quarterly basis. But I think putting all of that data together, it's going to be very hard for Powell not to lean a bit more hawkish into these figures and really say they're not seeing the progress on inflation that they need to be confident to start to ease policy.
This 1.2% increase in the employment cost index for the quarter was the biggest advance in a year. We're looking at a reacceleration at a time where even Citigroup, you believe that there is going to be a rapid deceleration and still a significant number of rate cuts later this year. Does this make you rethink that?
I think it's very challenging because, our base case has been based on a market slowing in the economy as you get later in the year. And that on its own would give the Fed more confidence that inflation would continue to cool. But you've seen the start of this year, GDP growth came in a bit softer than expected, but domestic demand was running near 3%. So I would call that a pretty strong economy. Labor market indicators are cooling, but still at pretty solid levels. And as I mentioned, the wage growth data are just not cooling enough for them that they can have confidence that the inflation move back to target. So I think really the data both on the activity side and the inflation side are kind of moving against that.
There's also a challenge in this to the thesis that some of the employment numbers that have been really robust have been entirely driven by immigration, which has been disinflationary, and that we've gotten full employment without inflation. Do you think that these data that actually strip out some of the wage adjustments that we're seeing in some of the overarching payrolls numbers really presents a significant problem for that thesis?
Yeah, and this is really key. We get a lot of data throughout the quarter on the labor market, on wages. It's really when you get to the employment cost index that's sort of supposed to be the be-all, end-all for wage growth. That is by far the best measure and indicator of wage pressures in the economy because, as you said, it controls for composition a variety of other factors. Now, it's not perfect. Maybe we are seeing some distortions in the first quarter due to bigger price gains and wage gains that are hard to seasonally adjust or control for, but this is supposed to be the one that the Fed hangs its hat on to tell it really where wages are going. So I do think this is pretty difficult news for them.
If wages are too high and companies are keeping up with these higher costs, could this spell then maybe layoffs?
Well, right now what we're seeing is labor market has been fairly strong in terms of hiring. Wage growth has been somewhat elevated. Inflation's falling, so real wages have been pretty good, and that's fueling ongoing strength in consumer spending, which in turn is fueling more strength in the labor market. And right now we're really not seeing much appetite for layoffs. So I think more likely is you could get an environment where the economy stays resilient, but inflation just stays much stickier than expected.
Mike McKee, we wanted to bring you back into the conversation on the labour market. Can we talk about some of the numbers we're expecting to get over the next few days? Tomorrow, ADP and JOLTS, Thursday claims, Friday payrolls. What are you and the team focused on?
Well, I think the Fed, and therefore me, are most focused on Friday's, payrolls, because that'll tell us something about how tight the labor market is and whether this wage pressure will continue. If we continue to get the same kind of job creation, it doesn't suggest any relief on the wage side unless there's a big addition to the labor force. So it is something the Fed is going to be watching. JOLTS was important, less important now. It's been coming down. As long as it continues to come down, number of vacancies continue to come down, the Fed will be less concerned about that. So I think it's really the payrolls creation number and perhaps wages and salaries within that that are going to attract the most attention from policymakers, unfortunately, after their decision this time.
Mike, go get a drink. It's good to catch up with you. Mike McKee there, breaking down the economic data going into the Federal Reserve tomorrow. Payrolls, in our survey, the estimate 240,000. Rob, you've got north of 200K on Friday. Where's that coming from, and why do you expect downside risk from here? What's guiding that view? I know it's a house view over at Citi. Andrew tells us it every time he comes on. Where's that house view coming from?
Yeah, absolutely. And we are expecting the labor market to still hold up well, as you said in this report. And the idea of the economy slowing is that we are starting to see in some areas a few cracks. In particular, if I was highlight on the labor market side, if you look at some of the small business indicators that we track, those are looking kind of worried worrying, especially the survey data within the NFIB. That would argue that hiring is likely to slow a fair amount. That being said, as noted, the data have been kind of going against it in the first quarter, and we've seen upside surprises in payrolls throughout the first quarter, and over 200,000 in April is fairly strong number. So that's kind of the basis for it. But right now, I think the labor market's been holding up fairly well. There's been an ongoing debate through the show this morning about whether or not Fed Chair Jay Powell is going to be interesting at all, but also whether he's going to answer the question about whether a rate hike could potentially be on the table for any reason. You don't think it would be. You think that we're sufficiently restrictive. But do you think that this is a Federal Reserve that has to indicate some level of sort of, retracement from the pivot last year, just simply because you need an economy to run cooler with a market that really does sell off? And this is a key point. And I think for the Fed, and you've heard Powell say something along these lines, they do feel they're restrictive. They would rather just hang out at these levels for longer than have to raise rates again. I don't think it's completely off the table. I think it would take something like an acceleration in inflation from where we are and a continued acceleration through the year to really get that conversation on the table of raising rates. So I don't think he'll lean into it. I think he'll still say that they feel they're restrictive, but that they could hang out here for longer if they need to. Do you think he's going to be boring, or do you think he's going to come out and try to make people feel a little bit more bearish? I think he's going to be a little bit boring. I would expect him to come in and say that, not to say the Fed chair is ever boring, but that he'll come in and basically say that exactly as we're seeing that they don't have enough confidence yet. That the economy remains resilient. They do think inflation will move back down to target, but the data are kind of moving against that.
Would you like us to do a show tomorrow when we don't have to? We don't have to turn up.
Are you lobbying him or are you lobbying
No, just, for the people who make the promos who are in the newsroom, if you want to put that promo on a little bit later,
still newsworthy.
Just take the three guests we've had this morning that just say it's going to be boring and suggesting Chairman Powell shouldn't even speak. Robert Sockin of Citi. Robert, it's good to see you. Thank you, sir. BlackRock's Amanda Lynam writing this. Policy normalisation in response to improved inflation is a supportive backdrop for credit. An extended delay beyond 2024 for rate cuts because of economic strength would likely be more easily digested by credit versus a postponement of rate cuts because of a sustained reacceleration of inflation. Amanda joins us now for more. Amanda, this is brilliant. Not all rate cuts are created equally. Not all delays are either. Is this a healthy delay?
Well, good morning. Thank you for having me. So far, it seems like a healthy delay because it's supported by resilient growth. I think the concern that we have is that the longer that these rate cuts are postponed, the more credence we get to the possibility of rate hikes. And that uncertainty around monetary policy is just not a great backdrop for credit. It's not a great backdrop for M&A or deal making. It's clarity on the macro that we need, not necessarily a favorable macro in terms of rate reductions. It's really that clarity that's key. So that's why we're focused on that.
What we've had so far this year has been a pretty resilient credit market in the face of a repricing of interest rates higher. What's behind that resilience, if you could go through the list for us?
Sure. So a couple of things. One is resilient growth, and I think that's been particularly important for speculative grade issuers that are more growth sensitive. So IG issuers have more of a cushion. They can handle a downturn in growth. High yield and leverage loan issuers, not the same defensiveness there. So growth is number one. Two is the yield backdrop. We've talked about this before. Spreads are tight, but yields are really attractive in the context of the post-financial crisis era. So if you're an insurance company, a pension, an endowment, you're looking for yield, it's been an attractive area to deploy capital into credit. But it's not been resilient across the board. I heard your earlier segment where you were talking about kind of triple Cs. It is true that triple Cs outperformed on a total return basis, but that's largely been driven by rates because triple Cs are less duration sensitive than, say, double Bs, that high end of the high yield spectrum. If you isolate credit spreads, which I would argue view, is actually the true measure of credit risk. Triple C's have been lagging, and so if you take the index level spread of high yield, 299, very tight, that would suggest that Triple C should actually be somewhere around 600. They're around 720 in spread. So Triple C's on a spread measure, which I believe, again, is isolating that credit risk, has not kept pace with the tightening overall. That's also true in the loan market where Triple C's have lagged. So the market is efficient in telling you that not all of these companies can navigate high for longer the same way.
And it also expresses some concern about a lack of clarity around what the path of rates is going to be and how punitive that's going to potentially be for companies. Earlier this morning, we had Julian Emmanuel, who was talking about popping the question. And he was talking about how someone, maybe Michael McKee, is going to ask the Fed, well, under what circumstances could you imagine ever hiking rates, or is that off the table? Do you also think that that actually could really cause a massive dislocation in credit if he answers, yes, we think that we could under certain circumstances?
Right. So two things I'm watching for tomorrow. One is there an acknowledgement that we are at peak policy rates? It seems to me like maybe the chair wants to step back from overstating that emphasis like he has in the past. So that's one. Two is how patient will they be to get down to their policy objectives? So how many more months of this kind of middle ground of not sustained reacceleration, but also not declining inflation can they tolerate? So that's what I'm watching for tomorrow. As it relates to credit, yes, it will have implications, but I would expect that theme of dispersion, not widespread market disruption, to remain intact. One of the really interesting points so far this year is that over 30% of the defaults that we've seen in 2023, and this trend has continued in 2024, has been repeat defaulters. So these are companies that have previously filed and they're filing again, or they've previously completed a distressed exchange and they're doing another one. Why do I mention that? It's because a lot of these companies that are under stress are not coming as a surprise to the market, right? So long as we have this high for longer environment, what you would expect is that the same troubled sectors, capital structures that were kept afloat by low rates but are not actually growing in a capital efficient way would remain under stress. Does that cause broad market disruption in credit? I think the bar is still high for that. What could cause that is a sustained reacceleration.
Well, especially because Dan Greenhouse of Solus earlier was saying that basically this isn't my mother's high yield market, that this has changed, right? And that essentially we're looking at something that's grown up and become much better quality. Does that mean that the risk has migrated to private credit, where you have a higher degree of less tested companies?
I mean, actually, I don't think that the risk has migrated to private credit. I think in syndicated high yield, syndicated leverage loans, and private credit, you can find vulnerable companies anywhere. And in fact, what we're actually seeing is an overlapping of the addressable market between public credit and private credit, where companies are demonstrated access to both. I really think what it is that, say, take Triple C's in the U.S. high yield market. This is using Bloomberg data. Interest coverage is 1.1 times. Just the margin of cushion to navigate a prolonged environment of high interest rates is very, very slim. And for most of the credit market, we don't view a 25 or 50 basis point rate cut as material or game changing in terms of their capital structure. But there are some companies where they actually do need that. And I think what the market is telling you is that on the margin, there will continue to be dispersion. I think there are some themes like the repeat defaulters that we've mentioned. Loan-only capital structures have also been leading the charge in terms of defaults, not surprising. So there are pockets of vulnerability that you can find, but I don't think that it's a wholesale shift in risk.
Could you give us some perspective on the all-in yield opportunity right now? How great is it? How big is it?
So on a percentile basis, using the post-financial crisis period, it ranks around the 80th to 90th percentile, depending upon the region and the rating that you're seeing. So what is that saying? It's saying that actually 80 or 90% of the time, yields have been lower than where we are now. On the spread perspective, it's the exact opposite, where we're kind of hovering around the 10% percentile. So basically, spreads have been wider than this. So
you've got to help me. Is it a good opportunity or not?
This is a great opportunity. So this is So maybe this is a little too nerdy for early morning TV. So yes, it's a great opportunity to deploy on an all-in yield basis, but we acknowledge that the opportunity for material spread tightening is pretty limited, just given that we're at 299. The post-financial crisis average for high yield is around 460.
Are you seeing equity investors migrate into your world? Because we had a guest, Lisa mentioned Dan Greenhouse of Solus earlier on the program, and he was talking about very specifically about energy, he thought, relatively speaking, the opportunity was better in equity than it was in credit. Could you describe maybe a similar dynamic?
I would say on the margin, we actually kind of see the opposite, where we see equity investors and I would say this is very on the margin, take some chips off the table after some pretty strong performance and deploy into credit to lock in some yields. But I would say the conversation can go either way. It really depends on what the risk tolerance is, where the sector focuses.
Appreciate the depth. Amanda, thank you. Thank you so much. Amanda Lynam there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.